according to Peter Petrov, he's at Trading Key, he's a U.S. stock analyst. He says that projections suggest a $1.5 trillion funding gap. So it's interesting because you want to say the borrowing side's infinite, right?
Yeah.
And it literally, it seems, I mean, 1.5 trillion feels pretty infinite, right?
It's a lot.
It's a lot of money. Yeah. So, and this is, data centers, we're looking at H100 and B200 GPU clusters, energy. This goes through 2030. Private credit is expected to fill at least 800 billion of that need. So not only are we looking at, 2 trillion now, but then we're also seeing, in which, a substantial portion of that is already allocated towards AI and software. But in addition to that, data centers and GPU clusters, right, like hard infrastructure stuff, private credit is expected to fill 800 billion of that gap, and it's expected to grow 2 trillion. So you're saying, roughly 40 to 45% of private credit in the next 4 years is still expected to go into infrastructure. So, I mean, again, it seems like the biggest exposure, seems to be from not necessarily the aspect of private credit, lending. It seems to be the aspect of what it is lending into. And then looking at that from the perspective. But the thing is private credit is it's notorious. It's known to sort of be, lending that goes into, distressed debt securities, right? Like it's known to invest into those sort of companies. And it's been like that for a very long time. S&P Global says that private credit lending has exceeded broadly syndicated loan issuance for B negative and below rated borrowers for 4 consecutive years.
I read that. Yeah.
It's crazy. So then in the same report, US maturities of B minus and below rated debt will surge to a peak of 215 billion in 2028, which is up from 56 billion in 2026, 4x difference. And then creating a significant refinancing pressure for leveraged borrowers. And then in addition to that, securitization volumes topped 30 billion in 2025, according to Global Data Center, nearly tripling from just over 10 billion in 2024, with demand currently exceeding supply and sharp growth expected to continue. So from the economics perspective, you're an economics major. Yeah. The aspect here is you have this massive demand that's needed for AI data centers and GPU clusters, and yet there's very little supply. So, if 45% of that estimated, according to the stock analyst, 45% of that is expected to be private credit for the fund to fill that funding gap. I mean, from the economic side, like what exactly does that even entail? Okay. For the rest of the lending?
All I have to say, right? Because I'm about to nerd out right now. Okay. Listen, context, right? Context. I recently went on a little rabbit hole going down, understanding the blockchain and GPUs.
Sure. Yeah.
Actually, GPUs just got recommended. And you know what? That's a whole separate rabbit. So before I touch on anything, right?
Yeah.
Because the original question, like I'm gonna make this I'm gonna make this my anchor, right? Okay. Is that the original question is you're concerned about the investment or the private credit investment growing and the demand for GPUs increasing while GPU supply actually remains constrained. Is that that's kind of like
the
gist of your question.
I think that's a good area to go to.
Okay. So essentially, right, private credit invests into, actually, we'll start with GPUs.
Okay.
Right? So GPUs and other computer chips, we'll just say chips in general, right? Because GPUs is kind of broad.
Yeah.
Right. So we'll say chips and go even broader. Right. So we'll just take an average computer chip, and if you took like an average computer chip, say 10 years ago, right, you could probably hold one, in your hand just like this.
Yeah.
Right. But now in the same hand, you could probably hold, I don't remember the exact amount. I think it's either thousands but you can hold a lot of chips in your hands.
Oh,
right
now. Now.
Right.
Yeah.
And so I guess that really just goes to show that this is the technological advancement that we're seeing in technology and software infrastructure, through actual assets, right? Like through actual products.
Yeah.
So the interesting thing is these companies that produce, GPUs, computer chips, whatever, right? They extensively work towards doing research to make them even smaller, right?
Okay.
So if it's, I don't even want to say that it's a million, but I wouldn't be surprised if millions of computer chips could, like be
Oh,
held in your hand right
oh
now.
yeah. I'm
And
assuming it's
so
a substantial amount.
exactly,
Yeah.
right. There's a
Yeah.
lot. And so the money driven into this industry
Yeah.
is real. I do think that fundamentally is backed. It is sound because you're actively trying to increase the amount of units that you can produce,
Yeah.
right? For a cheaper cost. I think I left that out. The research goes into making, as many as you can, for the cheapest amount
Mm-hmm.
and as small as you can. So
Yeah.
it's really just the classic maximization.
Yeah, absolutely.
It's actually really
From
interesting.
the economics perspective,
Oh
it's
yeah,
just, it's classically maximizing. Yeah.
right. And so when you're looking at the industry as a whole,
Yeah.
you mentioned that there might be, constrained supply, and to be honest, I don't think that will be the case. I do think that you'll see that increased demand, and if anything, as demand increases, supply will also increase because the investment into research is either constant or growing,
Yeah.
right? And so when you see that capex, or not capex, but private credit is extensively investing into these industries, you're looking at industries that are actually looking to optimize 100% of the time, right?
Yeah.
110% of the time, it feels like,
Yeah.
right? And don't quote me on that. That's not an actual
No,
statistic,
no,
but
it's okay. Yeah.
right? But like that's, it does seem like that is what we're seeing in the market right now.
Yeah.
And so,
Yeah.
when you're looking at this industry as a whole, and what does private credit exposure look like in this industry? What does that mean for the rest of the economy? That specific sector, right?
Yeah.
Especially with the massive innovation that we're seeing right now, will be
Yeah.
our downfall. I think more private credit into other assets,
Sure.
and I'll just kind of leave it at that.
Yeah.
I think that's where you'll really see the most trouble with exposure.
Sure.
Right.
Kind of like what I was saying too is
Yeah.
if the private credit going into really, essentially, I mean, 40% of the
Yeah.
companies being negative cash flow. I think that's a pretty astounding statistic. So, but if
I
private
do
credit,
think that was the original question. Sorry.
no,
Yeah.
it was just related to
Yeah.
like, the aspect of, essentially a supply,
Yeah.
obviously there being a massive supply on the or a demand for, essentially there being a $1.5 trillion funding gap,
Mhm.
and 40% of essentially that is going to be, funded through private credit. Then overall, what does that mean for the rest? Where could the rest of that come in from? But no, I mean, you did go down like a really interesting route. No,
Yeah,
but you did go
yeah.
down from a good, to a good rabbit hole, which is, sort of related to like the smaller the chips get,
Right,
the more
right.
powerful they get, the more transistors you can fit on the individual chips themselves.
Yeah.
So then it's a better processing power, and it's
Absolutely.
doubled every single year
Exactly.
since I don't want to quote the exact year, but
Yeah.
it's doubled every single year from its inception.
Right.
And because the idea is like, the more transistors you can fit on a chip,
Yeah.
then essentially the more power it has. Now, obviously there's a cooling factor that needs to be considered, and there's probably a singularity point that it does get to. But as of right now, I mean, it has not stopped.
Oh yeah.
So these chips get more and more, and they're arguably much more expensive every single time, because you need really high powered pure gases to essentially, to create these chips in the first place, which, goes into an entirely separate area. But needless to say, I think the $1.5 trillion funding gap from AI into 2030, I think the reality is 800 billion. They say 800 billion is going to be secured by private credit.
Yeah.
I definitely think if earnings aren't materializing correctly in the way that people project them to by 2030, I think you're going to see different, extensions. You're going to see, you'll start to see defaults. You'll start to see private credit defaults rise.
Yeah.
That will be the indicator that it's systemic due to AI.
For sure.
However, I also feel like the 800 billion, for some reason, even though it's 40 to 45%, it feels light. It feels like it could definitely be, more than that. And the reason why I say 800 billion of that need is because, 800 billion of the total 2 trillion that would be going out of private credit. So 45% again,
Yeah.
of all of private credit lending is expected to sort of go into that AI area in the next 4 years.
Okay, I see what you're saying, and you'll be able to see if it's systemic or not based
Exactly.
off the default rates
So I think we could say, oh, it's too soon to say.
Yeah.
Oh, it's too soon to say. But if you're seeing, if you're seeing delinquencies rise, cash flow isn't income. Essentially, it's not materializing on the bottom line.
Yeah.
That's the case where I could see not necessarily it being systemic, but it could definitely be detrimental.
For sure.
And if private credit begins to be held in a lot of 401k accounts, I think that could also be a sort of issue there from the retail investor side, right? Because think about 2008. The whole reason why it was systemic was because it was sort of this, albeit it was a much deeper layered. You had mortgage-backed securities, and then you had collateralized debt obligations, and then you had essentially financial weapons of mass destruction. In this case, I don't think we're to that level. But it's sort of being questioned like that, and as it should be. The problem is it's just not regulated. As well as it should be.